How does the mortgage loan process work? Guys, stick with us and we're going to walk you through it right here.
You better get fired up.
All right, I'm excited today. We got Nate Jomaa with the Nate Jomaa mortgage team here today. Nate, welcome, man. I appreciate you joining us.
Thank you. Yeah, glad to be here. I'm excited about having the opportunity to talk to some people about the mortgage process. It sounds like it's a scary endeavor, but when you break it down and you work with the right people, it's really not.
I appreciate you coming on, man. One of the biggest concerns I get from buyers, and I shouldn't say buyers, first-time buyers. If you've done it once, you know it's a piece of cake. It really takes you maybe an hour, maybe a half an hour to get everything in, and then it takes your lender maybe a half day to get back to you with all the information. But really feeling it as a first-time home buyer, it can be overwhelming. It can be scary. So I thought, why not bring in the expert and walk us through from A to Z? What is a typical, and let's go with a first-time home buyer. What's a typical first-time home buyer going to go through as far as the process is concerned?
Sure. So our team starts with what we call the hopes and dreams call. And what that really is a fancy way of saying we're going to get on the phone or meet in person, and we're going to talk through what you are expecting to get in your first home. If you haven't bought real estate before, it can be a little bit of a scary endeavor. It can be a daunting process, but we break it down for you. So we'll ask questions about how long do you think that you're going to stay in this house? If you have a family that's growing, do you think that this house is going to be something that you might hang on to and move into a bigger house down the road? Or do you think that you might sell this house? We talk through some of those things because all of those things are really going to drive into the best loan program for them, whether that's going to be a short-term solution for them to get in and maybe get back out within 5 to 7 years, or if we think they're going to be in that process or in that home rather for 10 years or more. Yeah. And we want to understand over the next 5 to 10 years, what do you envision doing with this house? Because there's so many different ways that we can structure something. That really helps us understand the next round of questions. So we start with what we call pre-qualifying. And a pre-qualification is something a lot of people use interchangeably with a pre-approval. And I'm happy to break down what the difference is between those two things. But primarily a pre-qualification is going to be where we find out from you what you think your income looks like, what you think your assets look like, and what you think your credit looks like. And then based on how confident you are in that, that lets us know whether or not we should talk you through strategies to get prepared to buy, or if now might be a good time to take a look at that. And the pre-approval process that comes right after that is where we actually verify some of that information. So the initial meeting, the 10 or 15 minutes that we talk through everything, helps us sort of roadmap what we're going to do with you, either over the next several months, if it's a long-term play, or if you're out there and you're ready to go over the next 30 to 45 days. The pre-approval process, as you said, Joe, is very streamlined. We ask you to provide us with evidence of income, evidence of assets, and we look at your credit with you. And we just review everything holistically. We take a 360-degree view at your financial picture and where you want to go after we talk through things. And we get together and we look at several different options and we roadmap together which of those makes the most sense for you and your family.
I like that. So guys, if you're watching on Facebook, YouTube, whatever it is, if you want to put comments or questions in, feel free. And as Nate's talking, I will throw your comments up and he can answer those directly. Nate, you had talked about going through and creating the structure for what it is we're going to do. And there's different ways you can structure a loan. There's different ways you can structure an offer. Tell me about how some of those conversations go and why you might gear me one way versus another.
Sure. It's a great question. So if I think that you're going to be in a home long term, then when we look at what your down payment is going to be, I might suggest that you put a lower down payment if it's going to be a long play. And the reason for that is because you're going to find that when you put a lower down payment, obviously you get to hang on to a little bit more of your cash, but there's something out there that's called private mortgage insurance, or PMI. A lot of people hear the term PMI and it's a bad thing. I'll tell you why I don't necessarily think that it's a bad thing. It's a necessity sometimes, but it's not a bad thing. So when you put less down as a first-time home buyer specifically, with a conventional conforming loan, which is, if you will, just your vanilla regular loan, that allows you to only put 3% down. And doing so allows you as a first-time home buyer to qualify for certain programs under Fannie Mae and Freddie Mac, who are the investors that ultimately purchase conventional conforming loans, to have programs that allow you to have a lighter interest rate, to have expanded approval guidelines, and to have a lessened PMI, or private mortgage insurance premium. So
now, I got a question quick. If I've got PMI, how do I get rid of it?
That's a great question. Great question. So PMI is called private mortgage insurance, and that's basically an insurance policy that we ask you to take out to ensure that should you default on your mortgage, that the mortgage is still getting paid every month. It's an insurance policy because you're putting less than 20% down. And it will depend on your credit score and a lot of other factors, what exactly your PMI payment looks like. It's an annual premium. We divide it in 12, and you make 1/12 of that payment. There's two ways that you can get rid of that PMI. The first is, once you have about 20% equity in the property, then you can raise your hand and say, hey, Mr. Lender, I think I have 20% equity in my property, and I'd like the PMI to be removed. And we will get in touch with you, or you'll get in touch with us, and then we'll send a packet to you that walks you through the process. And it looks a lot like ordering an appraisal to verify that. And then depending how long it's been, there needs to be some improvements made to the property too. You can't just ride the appreciation wave. There has to be an update to a kitchen maybe, or to a bathroom, or maybe you've taken out carpets and put in hardwood flooring. There has to be some sort of market improvement to the house, and the equity is what follows. The other way is after you've gotten the loan to value, or LTV, to 78%, which is kind of a drawn out process and typically looks like you making 120 payments. Typically at that point, when we forecast out when it'll drop off, that's when it drops off.
Now, is that automatic, or do we got to get an appraisal for that one?
Good question. It's, in theory, it's supposed to be automatic. It could be sooner, it could be later. It just depends on when the loan servicer feels like you've gotten to that 20% equity mark, or excuse me, 22%.
Gotcha. So I'm aggressive, man. If I'm the guy taking out the loan, can I nudge that guy ahead a little bit? Can I call him in 7-8 years, or do I got to wait the full 10 years?
You can. Yeah, you can at any time, once you think you've gotten that equity in your property, raise your hand and say, I've got the equity and I would like my PMI to be removed. It's just, if you do it within the first couple of years, they're going to be looking for those improvements like I talked about.
Gotcha. Okay. So I've submitted everything to you. We talked through, maybe I want FHA, conventional, VA, whatever it is. But all of a sudden you get back to me and you say, Joe, guess what? Your credit's less than stellar, or maybe my income isn't where it needs to be, or maybe I'm 1099 and I don't have the time in that position that you need. What do you do with that person?
Sure. Well, we definitely work with them on a bit of a nurture, if you will, to make sure that we get them where they need to go. So if it's a credit challenge that keeps them from getting approved, then we work together to try to understand what's going on with the credit. Sometimes folks have credit balances on their credit cards that exceed the credit utilization that the credit bureaus like to see. And those things are weighted pretty heavily when it comes to mortgage scoring. So we'll work with them to try to develop a plan to try to pay down some of their credit balances so that they can get that utilization credit back. Maybe it's a matter of them having some collection activity on their credit, and we need to understand exactly what's going on with that. So we'll give them some tips and some guidance on ways that they can get rid of those collection activities. And if it's an extreme case where we can't help personally, we've got some credit resources that we can introduce them to. And that's a for payment type of thing. But we only do that in those extreme cases where we don't think we're going to be able to handle helping them out ourselves.
Sure.
If it's a matter of income, like you mentioned, 1099, and maybe the income just wasn't there, we'll walk them through what needs to be showing in order for them to show enough income to verify that they can afford this payment. Maybe it's a matter of assets. It could be that they just do not have enough saved up. We'll walk them through a couple of strategies to try to save some money. As simple as that sounds like something that a lot of people struggle with, is maybe finding a way to set aside a little bit of extra payment. So nothing is permanent. We work with everybody until they no longer want to work with us. But we'll follow them down the road as long as it needs to go. If it's a year, 2 years, or 3 years, we are committed to helping everybody get qualified to buy a house.
So a lot of people that I talk to, buyers that I talk to, especially first-time home buyers, they're on either one end or the other of, I don't need anything down and I can purchase a home, or I need 20% down if I want to purchase a home, right? The I don't need anythings can be a little bit overwhelmed when they hear what they need. And those thinking 20% hold themselves back for who knows how many years when they could actually have bought a long time ago. What's the reality of it? If I'm just a normal Joe off the streets, what do I need cash-wise to be able to get into a home?
Great question. So I talked about it a little bit ago. 3% minimum down payment on a conventional conforming loan, or 3.5% on an FHA loan. If you are one of those that served our country and you can get a VA loan, then you can actually get in with 0 down, and you don't have mortgage insurance on a VA loan either. So you can expect going in, let's just call it a conventional conforming scenario, that you'll need to have somewhere between 6 and 7% of the sales price, the purchase price, as your down payment and closing costs. So if you're looking at, say, a $300,000 home, minimum you need to have $9,000 down, and then you'll need to have possibly an additional $9,000 to $12,000 available for the down payment, or for the closing costs. And a lot of that can actually get offset by lender credits and a couple of other things. So even that number, is crazy as people might seem to think that is, it's not really that bad.
I like that. And honestly, I think that's a great number, right? So guys, if you're looking, and go shop, go look on Zillow or Realtor or wherever it is you want to look at homes that you think you would want. And then you can just assume on a 300,000, you're going to need about 20 grand, right? On a 400,000, you're going to need about 25, 30 grand. And now you know the price point that you need to get to. And like Nate said, man, those are not hard and fast numbers. There's way around them. But if you've got that amount of money, you're probably looking pretty sharp.
Yeah.
So Nate, you've got me now where I've submitted all my income documents, everything. And by the way, if I don't know what documents I've submitted, or I submit them incorrectly, which probably happens 90% of the time, Nate's going to call me and he's going to say, listen, you need to submit this, this, and this. I see you got the first 2, but we're missing that third one. And here's your repercussion, because people get so concerned about this. You just send it again. It's not a big deal, right?
No big deal.
So now I'm pre-approved with you. You've given me a letter. Let's say my credit's good, my income's good, everything about me is good, and you give me a pre-approval. How does that work, and how long is it good for?
Great question. So you're pre-approved. I've gotten your pre-approval letter to you and to Joe Rosen, and now you are able to go out and start to look at properties within your price range. Your pre-approval is good for a period of about 90 days. And then after 90 days, what happens? Well, it's real simple. We just verify that there's been no change to your income and to your assets, and we reissue it for another 90 days. So it's really not painful at all. A lot of people seem to think that they've got this window, they've got to go make it happen. That's just not the case. You may not find the perfect home for you within that 90-day period. And if you don't, it's not a big deal. You call my team, we will reissue that pre-approval to you after verifying that you're not in a new job with a new rate of pay, and that you didn't take all of your cash and go buy a car.
So guys, by definition, when you go under contract on a property, that's when the buyer and the seller have both agreed. They've agreed in writing, and it's been delivered to the other party. But you've still got maybe 30, 45, 60 days before closing in most scenarios, right? Yeah. So when you say 90 days is the amount of time I've got for a pre-approval, is that from the time I go under contract or the time when I close?
So the 90-day pre-approval period is just that. It's your pre-approval. So once a contract comes into our team, we immediately go into action to get some loan disclosures out to you to explain everything. We get on a phone call and we walk through the contract and the financing together to make sure that everybody's calibrated. And then we get the loan into what's called underwriting pretty quickly. That happens within about the first 5 or 6 days. Once it gets to underwriting, that pre-approval period has closed, because now you have what we call a conditional loan approval, which is just another way of saying your loan is approved, but we might need a couple of additional documents. And some of those things include getting the real estate appraisal back, getting the title work back from the settlement agent. It means we might need to get additional paperwork from you, or the underwriter wants a letter of explanation, possibly if you've had a job gap, or if you have a job that's not one of those normal jobs that everybody knows about. They just might ask for an explanation on what it is that you do and how you earn your income. So a conditional loan approval is just that. You're conditionally approved for your loan as long as we can provide them with the 3 or 4 things that they need in order to sign off on that.
That makes sense.
The loan approval process is where we are up to in this conversation. And that's the hardest part right there, is getting the docs in, finding the house, getting a contract, and getting the conditional loan approval. Once you've gotten to that point, it's all downhill from there, baby, because it's so easy to get through the rest of that. And that's what happens typically within the first 10 days after you get a contract in. We turn that around. So if you're looking at a 30-day close, that means that you're basically got the next 66% of the process done, and it's on us to work out the kinks. You're done.
So guys, while Nate's talking here, I want you to remember that the next 2 Fridays, we're going to have Nate on, and he's in one video going to get in depth on the difference between FHA, VA, and conventional loan products. And then in another video, he's going to get in depth on what happens in the underwriting process behind the scenes, right? We've all heard underwriting, but what really happens back there, he can tell us. So let me ask you this, Nate. Now we're under contract. Everything's been accepted. I'm good to go. Let's say I got 30 to 45 days to close. What are you typically, as a lender, asking me, the buyer, for? What are my tasks that I need to do between when we go under contract and when I actually close on the property?
Sure. So depending on how long ago the pre-approval was issued, we might ask for a refresh on bank statements and pay statements. And we're going to help you try to decide whom you should get your homeowner's insurance from. So a lot of real estate agents have preferred contacts, mortgage lenders have preferred contacts, but ultimately it's the home buyer's choice who they decide to insure their home with. There's a lot of different options. You can go directly to the carrier, or you can go through an insurance broker, an insurance agent who can help you find the right carrier for you. And that is pretty much it. You just need to give us the refresh documents, find some homeowners insurance, and then really the bulk of the work from that point until we close is on the mortgage lender and on the title company to just finalize some things.
And I'll remind buyers too, getting that policy, that insurance policy, to underwriting is part of the process. So if you think I'm going to wait until 3 days out, that's going to be a problem, right? Now you might create some issues. If you've got a good lender, they're probably bugging you up front anyway. But if they're not, because not every lender will, you could create a problem for yourself. And really, why wouldn't you? On one of the biggest purchases of your life, why wouldn't you within a day or two want to know where your insurance is going to sit, for numbers' sake, right? So literally all you're going to have to do is talk to an insurance agent. And I'll tell you right now, in Florida, you're going to get the worst possible insurance unless you've got a 4-point and a wind mitigation inspection that you can provide to that agent. Exactly. So even for you guys who are not doing inspections, you're still going to want those inspections at a minimum just to get the credits on your insurance. And I'll tell you, I don't know that I've ever seen a situation where getting the 4-point and the wind mitigation hasn't paid you back directly. Whatever those costs, let's say they're $400, whatever it is, you're going to make that back in your first year savings on your insurance, because your insurance is going to be so incredibly high without them. And with them, it's going to drop maybe 40, 50, 60, 70%. It drops considerably, right? So it's a no-brainer. So, okay, that sounds great. This process doesn't sound that bad. Let me ask you, once we're under contract, what are some things on the lending side? I'm not talking about inspections or anything like that, or buyers, sellers changing their mind. But on the lending side, what are some things that could happen that would make my loan fall through?
Sure. So one of the things that might come up is when you do have that inspection, you find that there's some concerns with the integrity of the home, or maybe there's some concerns with some of the vital parts of that home, whether it be the plumbing or the HVAC or one of those things. That could potentially cause you to want to get out, right? Yep. In terms of financing, maybe you have some undisclosed debts that you didn't share with us up front, and those things come up. So it's important when we're asking you these questions about your debts and what's going on that you are completely forthcoming with us. It's not going to hurt you to talk to us about that. It's going to hurt you later if you have things that you didn't tell us about. If you decide during the loan process that you want to open a new charge card, for example, that could be problematic because now we have a new debt that we need to take into consideration. And any payment on that, even if it's a minimum payment, is going to get brought into your debt to income ratio. And it's going to require us to recalculate your eligibility and your approvability. And then same with any liquid assets that you have. So liquid meaning any checking and savings accounts, any retirement accounts, brokerage accounts, any of those things. If the value in those drops significantly because you've either withdrawn some funds from it or you've shared and traded or whatever the case might be, that's something else that could become problematic during the loan process. Every now and then an appraisal will come back, and the appraisal will have some things that are going to be subject to repairs. Okay, so on the seller's side, we need to coordinate between the buyer's agent and the seller's agent to get a few things worked out. But as long as everybody's a willing participant and we get those things taken care of in order to validate the appraisal, then we're good to go. But those are some examples of things that we typically see that could potentially throw a little bit of a wrench in the works.
I like that. So as a buyer's agent, when I'm presenting an offer to a listing agent, I want to make that buyer look strong. I want to make them look good. And if I've got a good, strong A+ buyer, I might call the lender and ask for a DU or an LP. Can you explain what a DU or an LP is? And why would a buyer's agent want to ask for that? Why would a listing agent be looking for it?
Sure. So DU is desktop underwriter, LP is loan prospector. And I shared a little bit ago, there's two primary investors when it comes to conventional conforming loans. That's Fannie Mae and Freddie Mac. And so LP is the loan prospector, and that is Freddie Mac's automated underwriting system. AUS is another term for it. DU is Fannie Mae's automated underwriting system. And what that means, we ask you up front for verification of all of your income, your assets, your credit. We take all of that information that's verified and we run it through an automated system that bounces up against those guidelines. And it'll tell us everything that you put in. It's only as good as the inputs, which is why it's got to be verified information. But based on the inputs, what you're telling us means that this is a good loan, and we get either an approve eligible or an approve accept, depending on which, if it's a DU or an LP. And we on the mortgage side review those findings, and we understand what we need to do in order to fall in line with what those findings say. But those findings, for lack of better terms, are our Bible for how we need to move forward to get your loan through underwriting painlessly and get you to the closing table. And so a buyer's agent might ask to see that so that they can see that the buyer is in fact a bona fide, verified, approved buyer. So we send pre-approval letters out all the time, and we won't send a pre-approval letter unless we've already verified all of the things we talked about and gotten through the AUS, or the automated underwriting system. So our company runs what's called dual AUS, which means it runs it through LP and DU simultaneously. So we might find that DU is asking for things that LP might not. So it's advantageous for us to try to ask for less things with an assurance of approval. So we'll go with whichever one seems like it's going to be the best fit. So as a buyer's agent, as you said, you might just want to see evidence that this buyer is not just pre-approved, but we have that AUS to back it up.
You know, you brought one thing up that kind of just sparked a thought in my head. I, as a listing agent, get offers from great local lenders with great reputations. And then I also get offers with lenders in Kentucky who are licensed in Florida, or they're from Texas, or maybe they're from Fort Myers. They're still in Florida, but I don't know who they are, and they're not local, right? So I can't go knock on their door if I've got problems.
Sure.
There is a significant difference in the pre-approval letter I get from one lender versus another. I've gotten pre-approval letters that say everything looks good, and then a week into the process, hey, we got to back out. We didn't know that they had this debt. They didn't check it. They didn't verify it. But there are other lenders that have great reputations, and if I know who they are and I know what their work looks like, I know that that letter is as good as the integrity of the lender. And now I'm comfortable moving forward. So a lot of times as a buyer's agent, you'll read in the comments, we prefer a local lender, or we prefer whatever it is. And I think a lot of people think, well, that's not fair. I want to use my lender. And you should be able to use your lender. You can use any lender you want. But remember, in a multiple offer situation as a listing agent, if I know that Nate has a sterling reputation and when he gives me a letter, it's gold, and the other buyer is exactly the same with exactly the same offer, but their letter comes from somebody in New Jersey, and that could be the best lender on the planet. It could be the worst. I have no idea, but I know Nate. You're going to get your offer accepted more with somebody with a great reputation locally. And I want to point that out, because so many buyers, when you say, I really suggest that you use a local lender with a strong reputation, they want to stick with whoever, I'm going to call them out now, Rocket Mortgage or whoever it is, because they've got phenomenal marketing, right? So they get a lot of people. It makes sense. But anytime I see a buyer's offer that's got some lender from wherever, I'm picking on Rocket Mortgage right now, but some nationwide lender where I can't go knock on their door, I can only call them. They might not pick up when times get tough. I'm going to take Nate's offer every single time. And I think that's just absolutely critical for buyers to understand. Do you have anything to add to that?
No, but you're absolutely correct. When you're working with a local team, and I mean, at the end of the day, that's what we all are, right? Real estate agents and insurance companies and home inspectors and lenders, we all work together often. You see the same names on contracts. You see the same names on pre-approval letters. And when you're working with a strong local team that you know that you can trust, who you can reach out to, who you can bump into at Publix, you know, there's something to be said about working together and having these strong local relationships. And you're absolutely correct, Joe. I mean, you're going to find that the big boys like Rocket and them, they kind of just burn and churn. For them, it's a numbers game, right? The more people they can say are pre-approved, the more people they can throw against the wall, see who can stick, the better. It doesn't work that way locally because we have a reputation here in the community, right? If I make just an egregious mistake with Joe Rosen, he's no longer going to consider me to be somebody that he might accept an offer from if my name is on the certified or the pre-approval letter, right? So it's really a big deal for us as local professionals and local business, owners and entrepreneurs to make sure that we're always on our best game.
Yep, 100%. So let me ask you, where are 30-year mortgage rates today?
Rates are that's an interesting question. There's so many different things that go into it. There's actually 26 different factors, if you really want to get nerdy with me, that dictate what the rate is. Generally rates are going to be driven by a couple of primary things, but then there's all these underlying things too. So credit score is a big driver. Your debt to income is a big driver. And then the type of property that you're looking at also could dictate where that rate falls. So a single family residence that's detached might have a different rate possibly than a single family that's attached, such as a townhome. It might have a different rate than a condo. It might have a different rate depending on where that home lies. But I can tell you that generally speaking, a conventional conforming interest rate today is probably going to be somewhere from the low fives, maybe up to the mid to higher fives in many cases, depending on how it's structured.
So when I'm looking up Freddie Mac average rates today, or I shouldn't say average, daily rates, what are they showing me with that 30-year rate? Is that the best possible rate that they're handing out, or is that an average?
That's an average. So they're taking kind of a median of all the different lending companies that are sharing their rates, and they're saying this is kind of where the 50% mark is, if you will. So that means that there's a 50% chance that your rate can be a little higher. There's a 50% chance your rate could be a little lower. Again, there's 26 different factors that go in. But the three big ones that we talked about are your debt to income, your credit score, and then the type of property that we're looking at. Those are the things that typically have what we call pricing hits. Those things change the price of the rate. Rates change all day, every day. A lot of people think that rates are kind of delivered by a man in an office somewhere, but it's not the case. Rates are driven by the 10-year U.S. Treasury, and mortgage-backed securities. And those are both openly traded things, and they change throughout the day. So as the market turns, so do rates. They go up, they go down. Yesterday, we saw rates go up. We saw rates come down all in one day.
So one of the big two questions that we're getting in the real estate industry right now is, where are rates headed, right? And I know over the last 50 years, the average rate has been 7-point-something%. We were considerably under that for a long period of time. We've had just a great period of time here in real estate. And we were in the 2s, the 3s, right? And now we've come up to, like you said, kind of the low 5s to the upper 5s, somewhere in the 5s. And it's even been above 6 for a period of time, right? Where do you foresee rates going, let's say in the next 6 to 12 months?
Sure. So everybody has a theory on it. Everybody's a bit of an expert, if you will. As a certified mortgage advisor, I actually do have a designation that just shows that I've spent a lot of time understanding the markets and looking at those averages and trying to help forecast. So I can tell you, based on my experience, my expertise, and then that's backed up by some of these folks that are just way more intelligent than I ever dreamed I could be. We're going to see rates stay rather flat. We're going to see some ups. We're going to see some downs. We're probably not going to see rates go down to the 2s and the 3s where we saw. We might see them in the higher 3s here, in the next 6 to 8 months. We might see rates go back down in the 4s in the next 6 to 8 months. But we don't think, based on looking at those averages, that we're going to see rates go any higher than the 6s or possibly the 7s. So we're not looking at rates just skyrocketing, if that's what the question is. We're going to probably be pretty flat. We can expect that somewhere in the 5s or 6s is probably a safe guess, but on the better side, we might see it go down into the 4s, possibly even higher 3s. It really all depends on the markets.
So what's your suggestion to a buyer who wants to get a home in the next 60 to 90 days and their rate is, let's say, 5 1/8? And they say, Nate, I just want to wait until it dips under 5. Can we wait? How does that process work? And what would you recommend to that person?
Hey, I would tell them that if they want to wait, then absolutely they should wait. But what they need to understand is while they're waiting, homes are appreciating. So that rate that you're going to get that might be better than it is today, it's going to give you a higher payment, because guess what? That home is going to cost more. So the cost of waiting is a lot.
That's a good point. That's a good point. All right, last question. This is the other big question of the two that I'm hearing right now. Where do you see prices going over the next 6 to 12 months in real estate?
Oh, great question. So I think that we're already starting to see that when it comes to sales prices, that we're starting to see a little bit of a breather on that. They're coming down ever so gently. But I want to remind everybody that when you see home prices starting to possibly come down a little bit, and I mean a little bit, we're not talking about tens of thousands of dollars here, guys. When you start to see that, though, that does not mean that homes are depreciating. So that same home that Joe can sell today for, say, $750, last year was not worth $750. It might have been worth $710, $720. So while you're still buying houses that maybe have a slightly less expensive price tag on them, those houses are still appreciating. Those two things are not the same. A lot of people think that because they see home prices coming down that they're losing equity. That is not the case.
So do you think prices will continue to come down? Will they stay stable or will they go up?
The finance guy in me wants to say that we'll probably see a more naturalization of pricing. We've seen an increase in pricing here through the last couple of years as rates were lower. There was way more people out there shopping. So it was a very competitive market. There were a ton of cash buyers. There still are, but maybe not quite as many based on the understanding that I have. And so I think we'll see prices level out a little bit, or maybe go back to where there's more ability for people to get in on them.
Interesting. I like that, man. So if these guys want to find you, where can they find you? Either on social media? How can they connect with you?
You can connect with me on any of the social media platforms at Mortgage by Nate. I'm on Facebook, Instagram, YouTube, LinkedIn. I'm not in Mortgage by Nate, but you can search Nate Jomaa and you'll find us on there. I started to try to TikTok, but I feel like I have a lot of homework to do on that. So
you and me both, brother. Well, guys, I appreciate you joining us again. If you've got any questions, comments, anything like that, go ahead, put it in the comments, either on YouTube or on Facebook. Nate or I will always get back to you. And again, if you want to join us for the next 2 Fridays at 10:45 on Friday, we're going to be back again with number 1, the difference between FHA, VA, and conventional. And number 2, what does that underwriting process look like, right? So, Nate, I appreciate you joining me today. We'll see you next week, brother.
Awesome. Thank you so much.